Hello everyone, Jesse Webb, TradersPro. Market conditions mildly bearish in a bull market. We have been talking about this a little bit. We've ticked back up right here on this uptrend. I've got a couple of things to go over today regarding kind of the quality of this trend. And let me grab my drawing tool here. Mildly bearish bull market. Shorter term signals, we had the Fed move yesterday, another interest rate move, and one of the issues with this current trend, I've talked about this for a few weeks now, and that is we have multiple things. We have some resistance here on S&P 500 that is continuing to come into play right here. We have this really choppy move here, which is not a trend. It's not looking like a trending move. Trending moves are typically like this, and then counter trending moves are something that are a little bit more choppy along the way. Obviously, a trend is a trend, but sometimes they unfold just slightly differently, and that's kind of happening here, where we're getting this back and forth chop. There's just not a lot of commitment to these trends, and that breadth indicator helps see the commitment to that trend, and we're not seeing the commitment here either in the overall breadth, where typically we see in some of these, even towards these bottoms right here in this last move, or these last couple of moves back in the fall and in the winter, where we had this counter trend and chopping around right here. We had these strong moves and breadth really popped, but we're just not seeing that, even though we're seeing price moving higher. That can sometimes be like a diverging type signal, when the market price is doing one thing, but some of the internals are doing something else. That can be a contrarian type indicator, or just not a confirming indicator. So there's some weakness there. The other thing that I really don't talk about much, and that is this link right here, which is the bond yield curve. This is the bond yield curve going back 20 plus years, and typically this is kind of the broad economic type of indicator. And one thing certainly to be aware of, because it is pretty consistent. If you go back here to 2000, kind of the dot-com boom, we've really in the last 25 years had three real big cycles. One was the dot-com boom and bust. And if you notice right here, as things were starting to climb, watch this red line down here. A typical yield curve, a normal looking yield curve, is when you have the shorter end of the curve here, interest rates are lower, and the longer end of the curve, 30 years plus, treasury bonds are typically offering a higher yield. You want to get paid more for locking your money up for a longer period of time. This is a normal, healthy yield curve, which typically happens towards the bottom end of this range. So right now we're sitting, or towards the upper end of these ranges. We were sitting right here. If I drag that mouse back over, you can see this is an unhealthy, or an inverted yield curve. The inverted yield curve, you may have heard of that term, is when basically you have the shorter end, a 2-year treasury, which is paying more yield than a 10-year treasury. If that's the case, if this is paying more to lock your money up for 2 years than it is to lock it up for 10 years, why on earth would anybody lock it up for 10 years if they only have to lock it up for 2 and get paid more money? So that's part of the point of when the Fed starts manipulating interest rates, is to play with this yield curve to kind of control the economy. And that's what's still happening right here. So if you look at this yield curve of .com, and then it moves the bottom, you end up with a healthy yield curve. Well, as we start to climb, 2006, 7, the top, throughout most of 2006 and 7, which was kind of the subprime debacle, and we had a couple of failures with Lehman and multiple things happening there as well. But you'll notice the yield curve was also the same right there. And then it drops, and as we drop down, well, look what happens. We get a healthy yield curve, and look where it happens, okay? So historically, and we could go back a long time. We can only go back this far on this chart, but if this yield curve mentality is playing with the Fed. And that's just one of the things we have to be able to do as traders and investors, is deal with what the Fed is doing, because it affects interest rates and equity rates. But now let's look here. So this long bull market that we've still had a good looking yield curve, but then we had COVID. Interest rates are rising. That red bar, watch that red bar. It's kind of moving around right here. We had COVID, and look what happened right after COVID. We had a healthy yield curve, but it was next to nothing on interest rates. Well, what's that going to do? That's going to create a huge amount of buying. It's putting a ton more money back into the system because interest rates are so low, both on the short end. Basically, they're zero cost to capital, which is huge for spending. So now you have more money out there chasing less and less goods. Well, what does that create? It creates inflation. Okay, so now you have inflation, which is prices going higher. And look what this was the move after COVID. Equities were climbing. Okay, well, now we start to get to this peak. We still have a healthy looking yield curve. Well, now we've had this last year, and now look what's happening to the yield curve. Okay, yield curve is now, this is as of today. So you tell me if this is a healthy looking yield curve or not. It's not. Okay, when you have 3-month treasuries paying more, almost double than 30 years. This is what the Fed has been doing, and this downturn more than likely is not over, because where did downturns happen, or where do reversal points happen? They happen when you have a healthy yield curve. This is not a healthy yield curve. So that's one of the reasons why this counter trend, while it's been so moving along, over a year now, it's still a risky uptrend, because this overall economic perspective is not, it has not healed itself. The Fed's job is just just a long ways from being over, and so we need to have that in our mind in terms of the quality of this rally right here. So be aware of that. That went a little long-winded, but let's jump into let's go back to buy-sell ratio. We're just still seeing some bearishness there. Be aware of that. Sentiment, we're seeing a pullback potentially back to this support area. So that does still have a little bit of a bullish tone. Buy-sell ratio has a little bit of a bearish tone. Overall up market now it's trending a little bit higher. We've got all kinds of just conflicting signals right now. Even our color on SPY right here is just a mess. Okay, this is the kind of market that we're just not super interested in. So that means some of these may be starting to fail. Obviously, a lot of things can happen. We've had a ton of volatility right here, but that just means raise your awareness of possible reversals right here and the quality of this uptrend. That just simply means position size. Make smaller positions, make less bets on overall stocks and direction. Only trade what is working, and currently that's in the new buy list. Let's take a look at that. So let's look here on new buy list, and there's a couple in here that look pretty good. Of course, we've got some medical drugs in there. The next one on the list, this is probably the best looking one of the day, even though it had a pop of 18% yesterday. It's got a good looking pattern setting up as you have these long contracted counter trend moves that look like this, an uptrend, a pullback, finding some support, and then some more upside. It really would, if it could clear that and break out of that, would probably get some continuation move. But that's that 18% is the only issue on that it had such a large move that forces you to create your stop loss down at this low, which is an 18% stop, and that's pretty wide for this methodology. If we look at some of these others, MLTX, medical biotech, another big gap here on computer stock, 30%. As I've talked before, if you get up into this extreme range, give it a little bit of time to pull itself back into this zone. And sometimes these continue, but these levels are just not sustainable. They don't last. So if you're looking at a chart and it looks like this, just say to yourself, okay, I'm not interested quite yet. Yes, it had a big move. Yes, there may be some confirmation, but the probabilities of it at least pausing or having some kind of consolidation or even a little bit of a reversal is fairly high on these locations. So even though it's a new buy signal, it's a little bit extreme. There are better candidates. COCO, beverage company, nice looking breakout here, fairly tight consolidative move, good looking price pattern, a little bit extreme, but in this case, because it is a breakout, be watching for some possible continuation on that. If you don't have full access to the site and software, you can sign up with the link below, and we look forward to having you. Have a great day today.